Okay, so I'm gonna start the lecture. The recording's here. It's Friday night, so I know BB told me that he was out with his other, and I'm sure Niku is enjoying time with his family, and other people are enjoying their weekends. So you guys are the grinders who are here on Friday night.
Yeah, we have no life. Yeah.
Good, and neither do I. And I'm okay with that because this is the best time to learn, guys. Honestly, if, I'm telling you, you put the time in now, you're gonna enjoy your life later, right? There's no such thing as something for nothing, and when you realize that, it makes it a little bit more bearable. Okay, so let's get into today's lecture, everyone. Today's lecture is going to be on FVG Secrets 2. Wow, I even come up with like nice names for them, don't I? So we're gonna talk today
100%.
about candlestick dynamics. And this is a concept taught by someone called Arjo, I believe, on Twitter. But I'm going to add my own MMXM twist, like always, right? I don't ever just reteach things because I could just give you a YouTube video for that. What I'm going to do is integrate it into everything we learn because everything we always learn is going to come back to market maker models. The first thing I'm going to teach you is going to be more or less a derivative of how do we frame our fair value gaps?
I don't think you're
Not
sharing
sharing your
your
screen.
train.
Oh, guys, thank you. Thank you for telling me. That would have been terrible for the recording. Again. There we go. Now you can see my screen?
Yes.
Yeah.
Nice. Okay. So how do we frame fair value gap? Well, let me make sure. I'm going to just share my trading view because then the recording is higher quality as opposed to my entire screen. Let me... There we go. Okay. So how do we frame our fair value gaps, right, is the first question. So let's we always do our lectures like this, right? What are the questions we're answering? How do we frame our fair value gaps? Which fair value gaps, or what's it called, my FVGs, do we expect to stay unmitigated on the current side of the curve, right? Because eventually, right, 95% plus of FVGs get filled. Eventually. That's a key distinction. We're talking about on the current side of the curve. 3, right? What are the optimal fair value gaps to be retraced and therefore utilized for an IRL to ERL move? And all of this is in combination with FVG Secrets 1. And what do you guys remember the content of FVG Secrets 1, which was essentially how to frame breakaway gaps? Do you want a quick refresher on that? Or are we good?
Yes, please.
Okay, cool.
Yes, please.
Quick refresher on that. We're not going to spend long because I'm trying to keep these lessons now an hour, short and sweet, because 2-hour, 3-hour lectures, I know you guys get tired. And I know I lose some of you, and I've been working on that. So I'm working on trying to be more concise. It's something I'm learning. So FVG Secrets 1, the summary, was how to frame breakaway gaps, and we looked for 3 things in the market. So let's just go and frame one ourselves, and then we can just go through the conditions quickly. And again, this lecture, FVG Secrets 1, I'm going to link right here. PDRA selection FVG. So I'm copying the link in, and I'm going to just put it right here. Here is FVG Secrets 1, okay? You can see my screen, or you can click on that, and that's going to be the lecture in the Google Drive. But let's look at the screen here and talk about how we expect breakaway gaps. So there was 3 reasons I taught in that video, and the first was, right? Does someone remember those 3 conditions?
Yeah.
Okay, someone tell me. What's the first condition?
First one is that it sweeps liquidity.
Yep.
The second one is that it balances a price range, and then the third one is that in the 3 candle sequence, the third one closes above the second one.
Yeah, and we also create higher time frame structure, right? Or we have a balanced price range, you said? So in this case, what we can see is that there's a couple reasons here why we'd expect to see this as a breakaway gap. Without looking at the other indices, I'm going to assume that this is a breakaway gap in the market because it's part of this balanced price range in here, right? Actually, it's right here. Oops, sorry. It's part of this balanced price range in here. You can see it creates higher time frame structure, meaning we trade and we close through these candles, which now create this as a breaker. And again, we care a lot about the body closures, not the wicks. we create that higher time frame structure, and then we also have, right, potential SMT inside of here, which we saw today in real time is referred to as our PD array divergence, right? And PD array divergence is one of the other things that you guys can see my stream, right?
Yeah.
Okay, cool. PD array divergence is something that we also consider. Do you guys see that? Without looking, we can already consider the fact there might be a PD array divergence.
Yep.
So that's the gist. Go back to that lecture. It's an awesome one. I think Todd said it was one of his favorite ones. I believe I was talking with Todd and he said that. Yeah, he said that. So that's a really cool lecture that you can get some insights from. Now we're going to talk about candlestick structure and a market maker model twist on the candlestick structure taught by Arjo. And I'm going to link that as well in here because, again, I'm always learning and trying to teach you guys whatever I learn in relation to market maker models. So how do we frame our fair value gaps? So what we want to talk about is the 3 types of third candles we can see. So if you remember from the first lecture, we had the third candle displacing the second candle was a sign of a breakaway gap, right? Remember, if we go on the daily chart, we can also see that in our example down here. We have this third candle closing above the second candle, but there's actually more to it. There's not just this one candle condition of the third closing through the second. So here are the 3 types of, I already wrote this out earlier, I'm prepared. These are called the third candle conditions. And the third candle conditions, I want to make sure my OBS recording it is. My third candle conditions are going to be 1, a consolidation, 2, a displacement, 3, an immediate rebalance, and then this is the MMXM twist, right? We're going to combine this with ERL and IRL concepts. So let's simply talk about this first type of candlestick condition, because this third candle condition is the optimal fair value gap for us to look for an internal to external move. This is good and we can expect it to be traded into. That's a key distinction. So what does this candle look like? If we have a generic candlestick that looks something like this, we are going to define type 1 candle to look like this. It's bigger. This is a type 1 candle, okay? Now a type 1 candle is a consolidation, meaning that the next candle has not shown, right, any displacement higher, and it has also not shown a deep retracement lower. It is simply a consolidation. And on a lower time frame, what do we know is going to exist at the low of this consolidation? If we look at the internal dynamics of a consolidating candle, it looks something like this. Now we're using opening, high, low, close concepts, right? We have open, create the low, create the high, right? And now we're closing back near the open. Does that make sense? Do you guys understand how this would relate to a candle that looks like this?
Yeah.
Okay, that's a bullish candle. And it's not exactly the size, of course, because this close would be up here and this open and this high would be up here. But maybe I can try and do that for us just to make it a bit more accurate.
So that's sort of like the formation of the dojis also?
Exactly. It's an internal dynamic, right? This is what the doji looks like. And depending on the width of this body, or depending on the length of this body, we're going to see this candle close closer or further away. So if we look like this, it doesn't matter what it looks like, right? We can say it looks something like this, for example, and that's going to be the displacement away from the open, depending on where it closed. So this is our first type of candles. This is candlestick type 1, a consolidation. Now what's really cool, and some of my older students might have heard this before, and what Arjo doesn't talk about is if we have a 3 candle pattern, right? Let's say we have, let me try and find an example. Do you see how this fair value gap closes? What's the color of this down close candle? That's a, somewhat of a consolidation. What's the color of that candle?
The red candle, or
it's a red candle. What does that mean rests below this when we create that swing on this time frame chart?
liquidity.
Yeah, external range, right? So when we actually look at what the third candle formation color is a really weird way to say it, but I think the better way to say it is the state of delivery, right? We'll notice that if we put in a consolidating candle, that's also a different state of delivery, that we also create the conditions for lower time frame internal range liquidity to be resting above this, or a higher time frame internal range liquidity to be resting directly below a lower time frame external range. Like, let's look at the 4-hour chart. Do you see? We're actually creating this external range low and sweeping it. That's pretty interesting. Now, when we look at the state of delivery of candles, seeing that this is an external range on a lower time frame, like the 4-hour chart, or even the hourly chart, for example, if you want to use the time frame alignments of market maker models, makes it extremely likely that price will want to retrace this, because this is going to be a high probability stop hunt on your intermediate time frame. So when you're looking at your higher time frame and you see that third candle form, our first condition, which is going to be a doji, and that doji, right, is of the different, the opposing state of delivery to the first two candles, that means this down close candle is creating a swing low in the market on a lower time frame. And this swing low on the market on the lower time frame is the optimal candidate for a stop hunt of that external range low inside that fair value gap that exists. So that's an observation. Go and back test that. Don't take my word for it. See the observation you have with that dynamic, that third candle dynamic. And again,
But
what's up?
sorry, go ahead.
No,
I
go
just
for
had a question, but you can go ahead, man.
No, go for it.
I mean, but wouldn't that be the case, regardless of whether that third candle, whatever color it was, wouldn't on a lower time frame that would be creating
Swing
external
low?
range?
Yes, absolutely. Both ways, you're absolutely right. It's creating this swing low. But when you have a bearish day of delivery for that third candle, what does that tell you about the likely displacement of the next candle?
Right. You mean the likely displacement of the fourth candle?
Yeah, the fourth candle. I.e., is this fair value gap going to be retraced? You're completely right. External range, I probably didn't say that right. External range exists in both of these on lower time frames, right? But if we form a doji and then it closes as the opposing candle, so essentially we're switching from a bearish fair value, a bullish fair value gap is created, but that third candle puts in a consolidation that actually closes down. What does that tell you about the internal state of this delivery candle on the higher time frame? What's it flipping? Bearish, right? So does that give you Todd, would you think that makes it a higher probability or lower probability to come back into the range?
Well, it makes it higher probability because it's, I mean, just to me on that level, it's like the market will be less bullish at that moment. That's kind of clear.
Yeah.
You know,
Shifting direction.
but yeah, but just I mean, just that I'm not sure. I'd have to backtest it.
Yeah,
And
backtest it and see. Confirm that, right? Confirm if this showing of directional, this show of the state of delivery for that third candle flipping makes a difference in whether that fair value gap gets retraced, okay? So for example, let's take a look at some candles that don't have that. So do you see how this here is a doji? But we don't retrace it? Because the draw on liquidity might be just right above here if we look left. Oh, we're at all-time highs.
Also bullish doji.
Yeah, it's bullish. It's hard to do this example at all-time highs. Let me try and choose not an all-time high. Let me find an example of a doji. This is one of the types we're going to learn as well. Let's just try and find an example of an argument by counter. Okay. Do you see this in here? So, do you see how this candle is a doji, right? When this candle closes like that, we do retrace that, but let's see if on a lower time frame we tag internal before we tag external. This is a really good example here. So do you see how we don't actually tag internal before hitting this external? Let me just go to the left and draw the external. You see how we actually tag the external first? Here's the gap created. We hit external and then we tag the internal and then we come back up and then we go lower, right? So look at the daily chart. You see how this high is actually hit before we ever retrace this part of the fair value gap?
Mm-hmm.
Go in and back test when this third candle forms a doji. If it's the same state of delivery, meaning it's a bullish delivery, often you'll find that it meets the criteria of that first condition. Do you see how it's displacing the high? Just barely, even though it's a large consolidation. Sometimes that means, or at least from what I have studied, and again, this is something new, a new concept I'm learning, so I'm teaching to you. I have studied that often the state of delivery of this candle actually matters because it might just continue to draw on liquidity before coming back to the internal.
Makes sense.
And that's just an observation I've had in price. Don't take my word.
I think also putting it on as displacing the high also kind of makes more sense to me.
Yep.
You know what I mean?
Yep.
Like, I mean, it's basically what you're talking about. I mean, theoretically, it could be still the same state of delivery and not displace the high. I mean,
Absolutely.
that could happen too, but more likely is what you're talking about. And I think that is.
Yeah, where the candlestick like direction shifts, right, in that candle. But you're right. I think if it doesn't displace the high and it closed like very, very narrowly as the same state of delivery, it'd be the same argument. So perhaps I'm cherry picking from my back testing where I was looking for, like, I was kind of a confirmation bias, if that makes sense. Good point, Todd. Good point.
No, but yeah, but displacing the high makes sense. Yeah. Cool,
yeah. Okay. So this is the first type of candle which we want to see retraced. And again, we don't want to see it displace the high. Maybe that's the better point. Let's say we don't want to see it displace the high. Maybe the state of delivery is less important. I might have just had some confirmation bias while doing my own back testing, which is interesting to note because I just learned this concept about 2 weeks ago. So now we're going to look at when we expect this type of formation to occur, or not when we expect, what we expect to see after this third candle formation occurs. And this is ideal because it is showing that as price creates the imbalance, right? Say the imbalance is here. That third candle is not reaching higher. It's not going for some, say the draw on liquidity is here. Let's do this. Draw on liquidity is here, or right here. As this imbalance is formed that exists right here, this third candle is not reaching into this level. It is instead rejecting, right? I move into that liquidity, so it's rejecting in this area, and it's closing, right, as a consolidation, meaning there has been the creation, like we talked about, of an external range low that is very likely to be a candidate for a lower time frame sweep. And this lower time frame sweep is going to be exactly the catalyst, right, to use this internal range to now reverse against this consolidation high. Remember, this consolidation candle is now going to have an external range high, an external range low. We're in a range, and the best things that happen in ranges, the best ways to trade a range, right, are range deviations. Deviation of the range is the best way to trade a range, always. It's never good to trade range high, range low to this 50% mark, in my opinion, even though it's taught that way. So some people will say when you're in a trading range, what you want to do is, you know, short premium into fair value and then long discount into fair value. I don't believe in trading ranges whatsoever. I think that way of thinking is still likely to get you chopped up because this move, yes, if you recognize you're in a range, can be profitable, but I would rather just say I'm not trading until I get a deviation of the range and then an AMD. So this would be accumulation in this entire candle. There's an accumulation. Then manipulation, distribution, right? And you can expect to see AMDX because this candle is put in indecision as a consolidation. Higher time frame wick, higher time frame wicks on both sides of the candle are a lower time frame consolidation, right? The candle's not moving. We're staying in between the low and the high. So we have a range high, a range low, and we're closing in between it. And then we deviate and we want to target the highs. That's the internal, what I like to call microstructure for why a consolidation candle is a good candidate, right, for a fair value gap to be formed at the third candle level buy. Let's take a look at some chart examples and prove this to ourselves because, again, none of this is impactful if we can't prove it. Let's go back to some price action we don't remember because we all remember recent price action. Let's take a look at this. Is a good example here. This example here is fantastic of a consolidation candle. Now you notice we don't trade into it. What do you suspect might have happened on potentially ES or YM here, seeing that third candle condition as optimal for this fair value gap to be retraced? Anyone have any ideas?
They traded into it.
Yeah, that would make sense internally, right? With our argument. Let's see if it's true. Oh well, it's not true for ES. Does not trade into that gap, so this is a breakaway gap as well on ES. Let's see what we get for YM. Ah, there it is. Do you guys see that? The turtle soup? SMT divergence?
Yep.
Beautiful. So you can, this is how you can become proactive in understanding dynamics of price delivery. You can expect an SMT here because you have a optimal third candle condition. Now, you notice YM doesn't even create a gap, guys. But the fact that YM reaches up higher means that these two indices do not need to trade into this gap. Very similar argument to external range sweeps. And people are very familiar with using SMT divergences on external ranges. It makes a lot of sense. But PD array divergence is something I also use, and I've taught you guys, as something to take a look for, because it's an internal range divergence. It's showing relative weakness on the indices that do not trade into that area. What's up, Todd?
Can we see see that bit of price action on the 4 hour?
Yeah,
or
of course.
hourly?
Let's do it. So we want to look for this to be a consolidation. We want to use the hourly, so we have the market maker model time frame alignments.
Right.
It's right in here, right? Do you see how that candle is a consolidation? It's beautiful.
Right. So it's kind of, it is external on the hourly.
Yeah.
Right?
Yeah. It's exactly, it's external range liquidity right here, right?
Right. It means external range SMT.
Yes.
On the,
yeah. Exactly. And it's internal. Yeah. Precisely. So a higher time frame, right? PD array divergence is a lower time frame. What? Turtle soup.
Yeah.
Someone said it. Who said turtle soup?
Yusuf did.
Yusuf. That's what it is, right? Todd, does that make sense?
Yeah.
No, I didn't say anything.
Okay, but does that make sense? That response?
For sure. Yeah,
Okay,
that's what I was
so
looking.
perfect. Yeah, it's a really good observation. I like how you asked that question because again, it's not intuitive. It's not immediately intuitive, right? You have to actually look at this chart and be like, oh, I can clearly see external range highs here. Because on the daily, it just looks like a candle. But this turtle soup here is a PD array divergence, and it depends on the time frame you're looking at. Just like a lower time frame fair value gap is a higher time frame, or a lower time frame balanced price range is a higher time frame what?
Wick.
Yeah, right? If I see a candle that looks like this, what do you think I'm seeing in this long wick? I'm seeing overlapping fair value gaps. Right, this is what the candle looks like.
V.
Yeah, it's a V shape, right? This internal state
V-shape
delivery is
recovery.
this. And that's why this candle is wicking within the time frame of the higher time frame candle. Beautiful, beautiful observation. Okay, cool. So that's a perfect third candle example. Awesome. Let's get rid of this and let's find one more and then we'll move on. I'm trying to keep this 15 minutes an example so we have lots of time to ask questions at the end and then wrap up relatively quick. Okay, let's go to just our NAS chart again. Okay, cool. Let's find another third example. Let's maybe do a bullish case this time. Oh, this is beautiful here. Actually, you know what? Let's not choose this volume imbalance example just because that might be a special case. This one's beautiful. And we're going to also use this candle in context with our market maker models. This is where Afiz is adding his own little elements to this narrative. So, what do we see this candle, first of all? Does this candle fit our condition for the first type of candle being a third type of candle being a consolidation?
Yeah.
Yeah, it's a bit deeper here, right? But more or less, correct?
Yeah.
It's not egregious. Like it is a bit deeper of a retracement, which we'll get into, but it's more or less a consolidation. But what do you think I like even more about this example that has nothing to do with the third candle?
Doesn't displace the high.
Sure, yeah, it doesn't, but what do I like even more in the context of nothing related to candlesticks but ERL to IRL? This is the market maker model twist.
Order pairing.
Do you see how we have a failure swing here, guys?
Okay.
Equal highs, right? What does internal go to?
External.
EQ.
External.
External, right?
External.
Internal to external. So what do you think the dynamics of price delivery are as we leave a equal high? What kind of model is this, guys? I've taught it. It's one word, so it's an I.
Inducement.
Yes.
Inducement, yeah.
Leaving.
For value.
Yes, and those fair value gaps are the highest quality fair value gaps. I'm going to say it again. The inducement model fair value gaps are the highest confluence targets. And I built a whole model around this in 2023. I'm gonna put it a screenshot here just so we can all look at it right now together. Because this is an observation I had about price so long ago, but I never really combined it with all these other things that I've now learned, over time. This is the inducement model. I just shared it in the chat. You see how we have engineered liquidity and a higher time frame PDRA and discount? Now we're combining this concept with the third candle. Do you see how we're building on stuff we've been using? I mean, Yusuf, how long have I been using this model for?
Dude, a while.
2 years,
long
right?
time.
2 years.
Yeah.
And only 2.5 weeks ago did I add this third candle dynamic to it. But this is called authorship, guys. I haven't seen anyone else using the inducement model. I've seen people actually using it these days, like Alex and Kane use it in the lab, but I didn't. I've been using this for 2 years, and I didn't see anyone using it in October of last year. But adding the third candle is something that's awesome, because not only are we getting the confluence of an equal high, which I always used. I always use that engineered liquidity, equal highs, relative equal highs as part of my model, but I never considered the third candle. And now you have all the elements of a perfect third candle. This is right here. Screenshot it, save it, put it in your journal. This is the perfect. I'm gonna put it here. This is the perfect third candle. And I have a couple of examples in my journal that look just like this. It's the inducement model paired with the third candle model. IRL to ERL with a failure swing and a third candle consolidation. Mint. If you can see that and you can recognize that, you can trade the highest confluence fair value gaps. Always. Okay, that's my little rant. Again. Damn, right? And you can see that this reversal happens right here, right? Causing this, where is this failure swing? You can see that we do not have an SMT. So we don't have a reason to think that this is a just reversal, right? We don't have an SMT at the highs, which is important to notice. And I do take note of that because an SMT changes this dynamic, doesn't it? An SMT says that there has been order pairing of this high. But as you notice, there has not been order pairing of the high on any of the three indices. Seeing that, guys, a lack of SMT, a equal high, the inducement model. Some people don't use SMTs. They're like, I don't care about it for this FVG selection. I do care about it. I always use intramarket analysis. But seeing no SMT, equal highs, fair value gap, the inducement model, in my journal, it's AA+. This is the absolute best fair value gap that exists in the market. And if you find a better one, I want you to send it to me because I want to put that in my journal as well. I haven't found a better setup than this because this gives you explosive moves from IRL to ERL because you have every condition that's met. And yeah, it's not often you get this, especially on a higher time frame. Usually you might see an SMT up here. Usually you wouldn't put in a perfect double top and you wouldn't get a nice third candle consolidation. So that's... I have that in my journal as well. I think that exact example, or maybe another one I found. You can try and find some more. But yeah, maybe for homework you can find some more of those perfect examples. So let's move on to the next case. I don't want to yap too long. It's Friday night. But
Can you hear me?
I can hear you're a bit quiet.
Yeah, sorry. It's Darren. Yeah, it's a bit soft. Sorry, man.
Oh, no worries, bro.
Just a quick one. Sorry, I came in a bit late. I just wanted to ask about the three candle. Do you perhaps have any other literature on it that you could share?
Yes,
Sorry,
yes. There's
I will.
There's so this is called the third candle FVG something by Arjo. Okay, I put it in the chat. Do you see it in education?
Arjo.
Yeah, I learned this concept about 2.5 weeks ago from that, and I've just kind of combined my own market maker model knowledge and inducement like knowledge with it. You'll find that like
Okay.
a lot of times I'm like trying to learn more stuff from people that I don't usually watch. Like Arjo is one of the guys I've been watching more of recently to learn more. But I always want to relate it to what we're learning here because they don't all trade market maker models, right? But I believe that
Right.
every concept that's ever been taught in the IC school of thought, ICT school of thought, can relate to market maker models. I truly believe it because that's the market. And you can see that example right there. This perfect third candle is a perfect alignment with our market maker model, IRL to ERL, failure swing. So yeah, look into that, okay? That help?
Yeah, thanks.
Cool. And I'll link the video later, guys, when I upload this video. I'm not ever trying to claim that I can teach this, this part better than him, but, maybe you think it is better. Who knows? So displacement, breakaway. Let's talk about the second candle condition. So a displacing candle is something we talked about in the first FVG secrets. And that is when the third candle, again, draw a basic schematic here. Sorry, my art skills aren't great, but bear with me. Is when the third candle displaces, right, the second candle high. So I'll just say here's our second candle. So when this third candle closes above the high, we expect the fair value gap that's created down here. So I'm just going to keep the fair value gap there and I'm going to put it in a different color. Again, there's another candle that looks like this below, and that creates the gap, right? Sorry, excuse my really shitty art here, but okay, cool. Like that. So this is when the third candle displaces the second candle high. In this case, what we can say about the state of delivery of this candle, let's even make it more bullish. Let's make it like we have less of a wick here, more of a body. Yeah, let's do that. Okay, so when we get a clear candle closure above here with very little wick, what is that saying about the internal dynamics? When I say internal dynamics, I mean you have to go down a time frame and you want to look at what's happening in here. Well, the open high-low close of this candle looks like this. A short retrace back into the range, and then an immediate, right, higher set of price action. And we're closing, even, let's make this the most egregious example. Let's make it a really bullish candle. Now, what do you guys think the likelihood, right, for price to come back all the way down into this range is?
Lower.
And why would you say lower? I mean, obviously we can say it intuitively it's lower, but why do you think it's lower? Like, just other than the fact that we're so far away from it. What would that require in terms of displacement to come all the way back down? What do you think exists in this candle on a lower time frame, maybe? If you look at internal dynamics, what might exist in this candle? So this is a daily chart. What might exist in this candle on the hourly chart?
Heavy imbalances.
Yeah, real boom. That's it.
period race.
Yeah, there you go. You nailed it. You guys both nailed it, right? It's likely that if the candle is extremely bullish, the internal dynamics are also bullish. So price doesn't need to mitigate all of these and actually trade through them. That would actually be a signal that a higher time frame liquidity area might have been a draw, let's call it, may have been met. In fact, we would expect the internal dynamics to look something like this. So the next candle might open up and do this. That's still rebalancing areas of inefficiency, but it doesn't need to trade all the way into a deep, deep discount when we've already created internal displacement. So this is a whole idea of internal dynamics. What does this candle look like when you break it down? Every candle has an opening, high, low, close, and within that, there's different time frame structure. And if this is a daily chart, you can bet your ass the hourly is going to have imbalance in there. It's bullish, right? It's bullish displacement higher. So we need to consider how this candle is engaging the liquidity pool of the previous candle. You see, the third candle gives us insight based on how it treats the external range high of the previous candle. Because this is a daily chart. This candle high contains a lower time frame swing high. That's external range liquidity. And if we're closing through it, it's breaking structure. So for it to come all the way back down and then up, that would be unlikely. In fact, that would be seen as extremely lethargic price action, meaning we wouldn't expect that. We would not expect to see this if price has a draw on liquidity that's reaching for. Hence why you may have heard ICT say that imbalances are targeted once the curve, or once a target has been met on the buy side of the curve. We move from ERL to ERL, right? These are two swing points in the market. And we do that through the oscillation between IRL and the previous swing high. So the move from this higher time frame swing high, from this higher time frame swing low, will involve rebalance. It will. However, if the candle is displacing towards the liquidity, then we have to ask ourselves, right? Say there's a swing high here, and the draw on liquidity is this box. We're gonna call it draw on liquidity this box. And this box is the irregular draw on liquidity. If there's an internal range high, and we see this candle displacing and putting in a failure swing right here, well, what's the more likely option? Or what's the more likely outcome? That price reaches into the high, or that price comes all the way back down, then reaches into the high, then comes back down, reaches into the draw on liquidity. Well, you can see clearly that price is bullish and displacing towards this internal range high. Maybe it's swing high. So we can call this like a swing. And this swing is contained, right, in between our two higher time frame points. That's why the market moves like this, right? Because these retracements, okay, I don't want to get too complex, but retracements in the markets are lower time frame reversals. So what do we need to see for a reversal to happen, guys, based on our conversation today? There's two things that we look for.
Our time frame point of interest hit.
Yep. And SMT, right? So that
Yep.
means that if this candle wants to retrace on a higher time frame, right? That means it's a lower time frame complete sell model. And I don't believe that if there's a point here, a obvious draw it's reaching towards, that it's going to just do this. It doesn't seem likely. It just seems like it's going to do this instead. If this is the higher time frame draw, right? It seems likely to do this, guys. And you've seen this. And then reverse into the fair value gap and then expand because the higher time frame draws up here. And I promise you, you can backtest this and you can prove it to yourself. When we are displacing previous candle highs, right? The fair value gaps there are less likely to be traded to. Does that mean they don't get traded to? Absolutely not. There's nothing certain about a single, there's no rules or laws about anything we're saying. This is probability game. The probability that, again, I'm going to put a line here. This is the draw on liquidity. The probability that price does this in the next candle, right, is higher than the probability that price does this. Look at two outcomes. Sorry. Look at two outcomes. I can't go any more left. That's the problem. The two outcomes are these two lines. The likelihood, I'll make that a different color. The likelihood that price comes all the way down and mitigates its internal range, right, after displacing this candle high, would actually show quite a lethargic move into this liquidity level, which we would not expect if this is the draw. We'd expect price to quickly expand higher and then potentially reverse, because then from the reversal, we're framing an area of interest for another leg higher. This reversal, maybe I have an SMT, then we come back into the range. Yeah, sorry, Todd.
No, I think the point is also it's like that. If price were lethargic, then it would be the first option where it doesn't displace the high.
Exactly.
Because it's displacing the high, it's showing price is really not lethargic. So you know what I mean? So it's like that's like
self-fulfilling, right?
Yeah, exactly.
But sometimes this will happen. Sometimes we will get this. We will get this. Sometimes this will happen, but that's usually associated with, what do you think? What do you think this kind of move would be associated with? A big manipulation.
Yeah, high impact news.
Yeah, exactly. So you just nailed it on the head.
Yeah. Also, it kind of relates to your breakaway gap video or theories, because basically, if on a lower time frame you have several, let's say hourly in this case, fair value gaps. According to your theory on breakaway gaps, you would expect some of them to act as breakaway gaps, right?
Yep, exactly.
Also align it with a lower time frame market maker buy model.
Yep.
Right.
So what we can expect with these deep retracements It's maybe a high impact news folder, something like that. Could happen.
Right.
But I would not be expecting it. I would still be anticipating, right, this price action to form, unless it was like NFP or FOMC. I'd still be expecting this to be the more likely outcome. So let's go. And again, never take what I say at face value, guys. If you can't see it on a chart, assume I'm lying to you. So let's go find it on a chart. Because if we can't find it on a chart, we aren't going to trust it. That's the beauty of it. It's right here. We can go back and we can see it for ourselves. So let's look at this gap right in here. Actually, we just looked at that one. Let's look at a different one. Something we're not familiar with. Let's do a proof by disproof. It's one of the best things to do in math for anyone who's a math person. Proof by contradiction. Does this third candle displace the second candle? Nope. So proof by disproof. This is an example you can put in your charts, and we can first of all take a picture. So this is the third candle displacement. Proof by disproof, which is a valid proof. That's a confusing statement. Proof by disproof is a valid proof. It is, right? We're showing the exact opposite of what we expect. If this displaces, we expect it to be a breakaway gap, potentially. It does not displace, we expect it to come back internal. Proof by disproof. Let's find an example of a proof by proof. Here we go. And I really hope there's a draw somewhere to the left here. It's already been hit, but whatever. It's still completely valid. This previous candle high is a lower time frame draw. This previous candle high is a lower time frame draw. Absolutely, right? Probably forms an SMT up here as well. Let's see. Yeah, it does right here. There we go. There's the SMT. So, again, we can assume that based on just this reversal in the market, right? What does a reversal require, Yusuf? You're my
I do think PY and an SMT.
So you can start to assume where SMTs happen, right? You would not see this reversal without this SMT, because what's our higher time frame PD array? This is a swing high in the market. Why is it a swing high?
Yeah.
Because this is a swing low right here. Right? It's a change of state of delivery of the candle. Up, then down, then up. That previous candle high is being taken. But let's not get into too much about that. Let's just talk about this theory of our third candle. So, does this candle meet the criteria to be a breakaway gap underneath the buy-side delivery? Yes, no?
No. I mean,
No.
it hit the ERL swing.
What do you mean? Does this candle... Let me rephrase it.
Which
Oh, that one?
This... Okay, I'll delete everything.
Good candle.
Does this candle, right, qualify this gap to be a breakaway gap on the buy side of the curve? Just look at the candle.
On the buy side of the curve. Oh, on the buy side of the curve, yes.
I'm just gonna look at this, okay?
Yeah.
Don't
Yeah.
look at don't confuse yourself, because remember the statement: 95+ % of FVGs are retraced. That's why it's bullshit when people are saying like this is a bullshit statement, by the way. It's not helpful. What you need to say is that breakaway gaps remain unfilled on the side of the curve of their delivery. Does that make sense? Once you reverse the delivery, do you think a breakaway gap is going to get filled? Yes or no?
Yeah.
Of course.
Yes! So let's not say 95% of gaps get filled. That's bullshit, because this gap is not going to get filled, and we can anticipate it. We are not just sheep who repeat 95% of fair value gaps get filled. Of course this gap is going to get filled eventually. I can tell you that with certainty. Find a single fair value gap on the chart, and I will tell you with certainty it will get filled. Again, here, this fair value gap is a complete breakaway gap. Oh no, Afiz, it gets filled. Bullshit. This does not get filled on the sell side of the curve, does it? Can you guys see where the reversal happens? Where does the reversal happen?
Yeah, right there.
So this gap, and I'm sorry I'm getting upset, because I've taught this lesson actually before to like some people in one-on-ones, and they're like, no, but this doesn't actually work. Like this gap gets filled. And I'm like, it doesn't get filled. You're just looking at patterns. There's no narrative in saying this gap gets filled. This gap is not filled. In my mind, underneath sell side delivery, this gap was never filled. Underneath buy side delivery, of course it gets filled. All gaps get filled. Every gap in the market gets filled eventually. But this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days, right? It doesn't get filled until the sell side draw has been met. So let's apply. Okay, well, we may as well do both examples because we're here. Does this candle fit the criteria for this to be a breakaway gap?
Which candle?
This third candle here?
That candle.
Yeah, I'll start highlighting the candles. Might be easier
But
to see.
and now you're talking about the breakaway gap, not the yellow highlighted one.
Yeah, this one right here.
But then the third candle would not be the one that you pointed
this
to,
one,
right?
It's this one. Sorry. Oops. Does this third candle here? My apologies, Todd. Does this
I
third
gotcha.
candle meet the criteria to be a breakaway gap for this gap in here?
Meets one of them, right?
Does it displace? Oh, we're just looking at the third candle criteria. Does this displace the second candle low?
Yeah.
Yeah. So we can expect this to be a breakaway gap, correct?
Yeah.
Fantastic. Now let's apply a proof by disproof, right? Do we expect this to be a breakaway gap? Proof by disproof. Another one. Does this candle exactly?
No.
So now we have, guys, again, I can screenshot this, or you can just take note of this. This is a proof by the validation of the third candle criteria. This is a proof by the invalidation of the third candle criteria. Do you see how you're getting both of these criteria, right? Both of these logics meet. Proof by proof, proof by disproof. I'm not trying to sound mathematical, but like this candle doesn't displace this candle low. It forms one of the conditions we expected, which is going to be somewhat of a consolidation. Again, never perfect, right? It's never perfect on either side, but it's a consolidation. It's an inside bar, you could say. And this inside bar leads to a perfect, right, retracement. Now, this is not an inside bar. This displaces with a full candle body through here. We can expect that to be a breakaway gap. Proof by proof, proof by disproof. Now let's look at the... Yeah, go for it.
It happens again, right?
Where?
There's another fair value gap in between those two yellow.
Right here.
There's another.
Yeah, right here. Good eye.
Yeah, same thing.
Same thing, right? Proof by proof or proof by disproof with this one.
By proof.
There you go. So there's 3 great examples in here. I even missed that one. Sorry, I didn't even see that, guys. Not
Okay.
on the ball today. I can't believe I just forgot to see that from my guy. That was a perfect example as well. Good. You know what, Todd? I was testing you.
Okay. Test away,
I was testing
man.
to see if you're paying attention. Of course, I could never have missed a fair value gap like I did with ES yesterday, guys. Remember when I just completely missed these fair value gaps 2 days ago? I just didn't see them on my chart. Oh, terrible. Sorry. Okay, let's get back into it.
So just from my understanding, coming late to the party is, it's in the displacement. Is that the?
Yes, and it's in the it's in the displacement, but it's also in the internal I actually deleted the little schematic I had. It's in the internal candlestick dynamics, okay? In the recording, Darren, I have a schematic here of why it makes sense, okay?
All right, I'll get back to that.
And the recording actually shows the internal displacement of that candle that you're seeing on the higher time frame, okay?
All right.
Okay, is everyone comfortable with that displacement breakaway concept? Give me a yes or no. Everyone in the chat who's here, because some people are talking, but I can't hear others. So give me a yes or no in the chat. Are you comfortable with that third candle displacement candle concept? SM says yes. Mo says yes. Yes or no? Jazz, you have to choose one. Yes. I'm not moving on till Willie says yes, till Talon says yes. Now, yeah. Yes. What? Yes. Talon?
Yeah.
Yes. Ryan? Ryersil? Willie, yes. I don't know. I'm taking that as a yes. Rye, you good?
That's a big yes.
I'm waiting.
Can you hear me?
I can hear you now, yeah. Yes?
Yeah. Yes.
Good. Rye's good. Original, you're good?
Yes.
Okay, cool. No one gets left behind, guys. If you don't understand, you have to say something because we're all a team. We're a team. We learn together, and we will slow down if anyone doesn't understand. Trust me. You guys are going to help each other when you guys are back testing this concept, and you send pictures to each other in the group chat. Everyone needs to understand, or else I'm failing, and I don't want to fail. So let's
I
do it.
think Raz said he or she doesn't understand.
Okay, my Italian friend Raz. Nope, I need to go back and study. Better previous lesson, I guess. So Raz, in our one-on-one, just because everyone has said yes, why don't we go over this? Okay, I'm gonna make a note of this in our one-on-one channel. 1 second.
Sure.
So we need to cover the third candle breakaway from FVG selection 2. Okay. Perfect. We'll cover it in our next one-on-one, and don't worry, I'll make sure you understand it. It's my job. Okay, let's look at the last one, guys, which is the immediate rebalance, which is also going to be a breakaway, okay? It's the immediate rebalance, and I'm going to show you the candlestick schematic, because I know you guys love my art. This is an example of a third candle immediate rebalance. And this is a concept we've talked about in various capacities now, right? We now have talked about daily rebalance theory. We talked about immediate rebalance of inefficiencies, right? Or like inefficiencies that would be. And now we're exactly going to talk about a third candle immediate rebalance. So remember, an immediate rebalance can cover a fair value gap entirely, but it can also have a third candle immediate rebalance. Now that's going to be seen with a deep retracement. So I'm using the words immediate rebalance, but I also want you to think of this now structurally as a deep retracement. Now let's.
And it doesn't matter if it's does the state of delivery matter for this one?
Nope. It's gonna be just how the candle delivers the sell side or buy side wick. Okay.
All right, cool.
Now let's consider what the hell is happening in a candle that looks like this. I've done every schematic, so why doesn't someone tell me what this looks like from the open? Say this is a bullish candle. Yusuf, why don't you tell me what this looks like? I'm going to draw based on what you're telling me. So we open, and then what do we do?
Just drop down.
Yeah. You might trade down at one point in time.
Yeah, trade down.
And then what do we do in a long wick typically?
Via recovery. So just fast recovery.
That wasn't English.
I mean, recovery.
V-shaped recovery, right? Something like that?
Straight up, yeah, to the high, yeah, to the high.
This guy said V and shape in the same word.
I was trying to say like V-shaped recovery and say it at the same time. So right to the high, and then we just close. Yeah.
There we go. Awesome. Okay, Yusuf knows his shit. This is typically the state of delivery of that internal dynamic. And I say internal dynamic means a lower time frame to the candle you're looking at. Every time I say internal dynamics, I'm talking about a lower time frame, power of 3 move. Again, accumulation, manipulation, distribution, and every candle besides a candle that has a pure accumulation on both sides, i.e. an accumulating candle or doji, has some internal dynamics, right? You can use the concepts that we've learned like this and stuff like that, and that's why we call them internal dynamics, is because that's actually how they're being priced on every single opening, low, high, close. Every single one, no matter what time frame. The internal dynamics look like this. Fantastic. Why would the FVG that rests here not need to be retraced? Someone tell me. So again, this doesn't actually tag it. It's right here. Give me an idea, someone. Why do we not need to retrace this FVG? This is the low.
The draw is higher.
Of course, the draw might be higher. What else? What about just the candle? Well, let's not look about ERL, IRL, because you're right. Who said that? Was that original or SM?
Yeah.
Original?
Mm-hmm.
Yeah, the draw is higher. So the immediate rebalance usually is a bullish signature and a higher draw. And that's using market maker model concepts. But what about just the candle?
We create like a balanced price range like in that wick.
I like that. I like the sounds of that. Okay, I'm hearing we create a balanced price range in this wick. I really like the sounds of that. Anyone else agree with that statement? Who else agrees with that statement?
Well, I mean, every wick by that thinking would have that, no?
No, not necessarily, but that's just an option, right? So I'm not saying that's the right answer. I'm just saying that's an option. We create a balanced price range. That's Yusuf's comment. Todd, why do you think we might not need to return back into here? That's one potential. So let's call this. This could be one scenario.
I'm not. I mean, I don't understand really the question. Like, why then it's a breakaway gap?
Yeah, why do you think, just from looking at this internal dynamic, that price wouldn't need to come back into here? One could be there's a balanced price range here. What other scenarios could happen? What other logic can we use to say this won't get retraced?
And you're saying that blue space is the adjacent
this is a fair
candle?
value. Yeah, this is a fair value gap. Sorry, this is the fair value
right,
gap directly below.
But it's like kind of like the adjacent one, like so it's the space of a.
Yep. Yep. Exactly. There's another candle that's So this is the third candle, right? So if we have 3 candles,
Mm-hmm.
the fair value gap exists between the first and the third. So let me
So that's the space.
yeah,
So
this is the space in between. Sorry, there's a body here and a body there. This is the fair value gap.
but then it's not retracing into the fair value gap.
Nope,
it's
it's
not
not. It's
creating a fair value gap, right?
It is creating a fair value gap, so it looks like this. I'll draw the
I mean,
plot.
I'm sorry. It is creating. It's not retracing into one, right?
Yeah, it's not retracing into one. No, I'm sorry. I didn't want to draw out all the candles, but there is a fair value gap that exists in between these 2 candles here.
I'm sorry, man. Anyway, you don't have to focus on me. I just don't understand because you were saying if that blue space is the second of a 3 candle sequence, and the one that you drew is the third candle.
So
right?
this is the third candle here.
Yeah.
And these 2 are the first. This is the first and second. So there exists a fair value gap in between that. I just didn't draw it out because I don't have space. That's all.
So sorry. So the candle you drew is the 4th candle then.
This is the third candle, right?
1.
Looks like okay. Let me. The third candle is the candle that we're looking at. Let me just show you right here.
But then it's not. Then it's creating a fair value.
It's creating a fair value gap. It looks like this here.
Right. So.
This is the fair value gap I'm talking about.
Mm-hmm.
Okay, so we have 1,
Yeah.
2, and this is the 4th candle rather. Yeah, sorry. Yes, you're right. The 4th candle. My apologies. 4th candle.
Okay.
Yes.
All good. Okay.
So what is happening in here that we might not expect it to come back in here?
So I will say that we trade up, we trade down, and we trade, like if we follow the roller painting analogy that we use.
Yep.
And then that range will be efficiently traded, so
Yeah.
there
So,
is no need to
we're
come
saying
back
it's
to
about
it.
yeah we're saying it's efficiently traded in here. Okay, that's one option. I also want to find a candle like this though. So I actually do want to find the correct candle because the concept I'm talking about is actually for this. I just didn't do a good job of explaining this. My apologies, guys. I'm a bit tired today.
All good.
Okay, this is the third candle, Todd.
So then it's not trading into a fair value gap. You're saying it's creating.
This is the candle that creates the fair value gap. Yes.
Gotcha.
The fair value gap is
Gotcha.
here. So I got confused with myself when you asked that question.
I'm
Because
sorry, I'm
I
sorry.
was thinking in my head, Todd, immediate rebalance. I kept saying it, which is the 4th candle, right? But I'm talking about an immediate rebalance of the 3rd candle. Okay,
So what? The question then
change this.
becomes, why doesn't it go down and create an immediate rebalance?
Yeah. Why? Yeah. Exactly. Why doesn't it create an immediate rebalance, or why doesn't the next candle have to trade into it?
Sure.
So we're just gonna call. I'm sorry. I'm gonna. This was confusing because the way I labeled it. I'm gonna call this a deep retracement third candle. Okay. So that is when the third candle in a fair value gap sequence, right? I'm gonna find an example right here.
Because it becomes an order block. I feel like I've seen that so many times.
Let me. Yeah. Here we go. There's not a fair value gap there. I want to find a really clear example that I can show you on these candles, so I don't have to keep drawing out schematics, and I'm not good at drawing. I'm gonna be honest. Okay. This is what I'm talking about, Todd. Does that make more sense?
But I
Third-
see that sequence. So then the question is, why doesn't
Yes.
that down close candle, the smaller one,
Why does
why
this-
does
no,
why does
the
it
question-
create a fair value?
Yeah, no, it does create a fair value gap. Do you see that?
Yeah, but the question is, why does it create a fair value?
Yeah. The question is,
Why
why doesn't
doesn't
this
the
4th
rebound-
candle have to come into it? That's the question.
I'm sorry, I couldn't hear you.
Why doesn't this
What?
4th candle here have to come into it?
Okay. I
Okay,
gotcha.
sorry. Let's repeat everything. And if he's had a brain fart moment, I am sorry. I'm only human. The third candle situation for this type of fair value gap that's a breakaway is an
Gotcha.
immediate rebalance candle that still
Gotcha.
creates a fair value gap. So we're going to refer to this candle as a deep retracement. So this candle is called a deep retracement candle, which is a form of immediate rebalance that still creates a fair value gap. Does that make more
Gotcha.
sense?
To me, it does.
Okay,
but-
cool. I'm so Will guys, I'm sorry. I'm sorry again. I'm human. I make mistakes.
No humanity,
as well.
man. No
I know,
humanity.
I know. Sometimes I'm like, I'm in my own head trying to teach. I'm thinking, I plan out my lessons, guys, and even sometimes I'm still in my own head while teaching them. Does that make sense, Willie, to you? what a deep retracement candle looks like? I'm waiting until you send something besides that dog looking awkward. Yes or no?
Nah.
Huh?
Yeah.
Yo,
It'll probably make more sense if you answer the answer to your question.
pardon me?
In terms of the answer to your question, what was the actual answer in
Yeah.
terms of why it doesn't fill it all the way down?
So the reason why price does not need to return back into this deep retracement candle is exactly why Boss and Todd both gave reasons for. One is that this wick may contain a V-shaped recovery, meaning a lower time frame fair value gap, right? So that means we are mitigating a lower time frame fair value gap. So in here, I can prove to you that this will look something like this. Okay, that's what this internal dynamic looks like right in here. Also, what we might have, what was the second reason? Is just to do with the candle displacement. So you can see that once we come all the way down, right? I want you to just consider this fair value gap as it forms. So let's replay price, and let's just use this example as the one example and make it extremely clear. As this candle prints on the daily, what are we actually forming? You can see at one point in time, this looks like this, doesn't it? Because that's the open, correct? Does everyone agree with that? At one point in time, the daily candle opens like this, right? Now, throughout that day, the entirety, I'm going to turn off my magnet. Throughout that day, the entirety of this large gap gets eaten away by balanced price. A wick is balanced price. What is a higher time frame wick? Always.
Lower time frame balance price range.
Yes. Higher time frame wick is always equal to a lower time frame FVG at least. Because let's not use the term BPR always, but we can say there's FVG in here that's being mitigated and we're going for it, right? We're going higher off it. Is that a better explanation for us? There's a lower time frame fair value gap in here that we are mitigating and moving higher from, correct? Always in a higher time frame wick. So what has price done? Let's look at the dynamics of price delivery internally, internal dynamics. We have opened, we have traded lower all to this, but this tiny amount of price action. So this is 90% of the gap has been closed. Then we have traded higher for 90% of this range. Traded up, created the high, and closed. Do we think that price needs to come back into this gap based on that logic?
No.
Why no? Everyone, tell me why no. Say why no. Why do you think that we would not need to come back into the gap? Because most of the price here has been rebalanced, right?
Rebalance,
Yeah, there's such
exactly.
a small amount of inefficiency, and then let's not even use inefficiency as the meaning. What about displacement of the candle? Is this bullish or bearish?
Bullish.
Extremely bullish internal dynamics, right? We are completely failing to displace lower. In fact, we displace lower and eat it entirely back up. Do you guys see that? We eat up all of this. What is the likelihood the next candle then opens and comes all the way back against that balanced price? Not very high, right? Would you expect in bullish price action for that to happen? You can clearly see the price, the draw on liquidity is higher. Remember, we're now combining ERL, IRL concepts. So we have this higher time frame draw, let's say this high, right? Would you expect, or even this high, would you expect that this candle now is going to come all the way back down into here before going up after showing us the previous day that it wants to eat up this entire range?
Yeah, no, you wouldn't expect it to for that tiny little thing.
Because we're reaching for what?
Or higher time frame point of interest. But I mean, let's say you have an immediate rebalance wick, right? Like it's not always going to be the case where the fair value gap is that small, right? Like if the fair value gap was bigger,
Sure, yeah.
So
Yeah, exactly.
So it could retain to it. So the case in which you would say, okay, this is an immediate rebalance is where most of the fair value gap gets
and that's what, that's why we're calling it a deep retracement. Okay.
Okay, so it's deep retracement,
yeah.
meaning it has to be a tiny fair value gap with it.
Yeah.
Okay, understood.
Or it could be a large fair value gap, but if for example, because the day is so volatile, right? Like for example, if this day had a deep retracement, that might look like this wick coming all the way into here. It still might be a decent fair value gap.
That's more, yeah.
But you see how so you want to compare the displacement range to the wick range. Does that make sense? That's the easiest way to say it, I think. You want to compare the displacement range that you see here, right, to the range that is produced by the wick. Okay.
Right. Yeah, I think that's important because otherwise it would contradict with one of the first things of the lesson, right?
Which is what?
Yeah.
I mean, like if the wick wasn't so big, then it would contradict the fact that the third candle that created the fair value gap doesn't displace the high.
Yes. Good point.
But I guess, yeah, I'm not so super familiar with like I'm just not really good with our rebalance redelivered. So I guess that's the key aspect, right?
Exactly. So what we want to compare is the internal state of delivery. And when the candle body of this candle does not close above this high, it's bearish assumed, right? The next day is bearish. And we do get a bearish day. But that bearish day is slowly, right, throughout the course of the day, reversed in our thesis. The next day you would look at this and not be bearish, right? You'd be bullish. Because let's look at the internal dynamics of this day, right? You can see this balanced price range, right? Look at the hourly chart. What do we see? V-shaped recovery, like Yusuf said, remember?
Mm-hmm.
So a wick on a higher time frame is a what on a lower time frame?
Rebalance fair value gap.
Yeah, it's a fair value gap or a rebalanced area of price, a V-shaped recovery. It's one of the two. It doesn't have to look exactly like this. It could also look like this, right? It doesn't have to form that immediate recovery like this. It could also be a two-stage recovery. Does that make sense? Like
I don't know why. I don't know. Excuse me. I don't know why. It just reminds me of like a second leg distribution.
Mm-hmm.
So I don't know. It just kind of reminds me of that, like that price delivery.
This in here.
Right. Yeah.
Is it?
If you go on the lower time frame, like we take out that like short-term low.
Oh, you're right. Yeah, it actually is. This is the silver bullet. This is the silver bullet in this fair value.
And that's an intermediate term like low, and then we basically go into the second stage.
So you're saying we're creating this intermediate term low here, right?
Yeah, exactly.
That's a really good observation, dude. Yeah, I haven't thought about that. This is why I like that's why I like doing the lessons with you guys.
Makes sense too in terms of like that second stage would maybe run to terminus quickest and give least possibility for entries.
Yep.
That's why we see that quick delivery too.
Yep. And that's why ICT always says that an immediate rebalance is one of the most bullish PD arrays, right? One of the most bullish signatures is immediate rebalance.
OG just said so. He said that ICT teaches that a range comes balanced if 50% or more of the fair value gap or imbalance gets filled or wicked.
Okay.
Is that? What do you think about that statement? Like yes or no?
If a range becomes balanced, are you talking about if it's an immediate rebalance like wick original, or just any fair value gap?
No, essentially a range. So, for example, like in terms, actually almost any fair value gap, if any fair value gap gets wigged up towards the consequent encroachment, and then it starts displacing towards the other direction, the direction of the order flow, it doesn't need to trade below that 50% range anymore. Similar to what you're saying exactly, which is a deep retracement.
Okay.
So obviously, the more it's the more 50% it is, then the less likelihood that imbalance that's remaining gets filled later.
Very good point. Okay, that's cool. Very cool. So we want to look. So essentially, what we can say as a rule is we want to look at the ratio between the open and the wick, low or high, and see if that ratio is like excessive, and if we wick more than half of that range, right? Essentially.
Exactly.
Cool.
A good rule of thumb will be if it's more than 50%.
Cool. I'm gonna do some backtesting on that original. That's awesome. I'm gonna actually backtest that specifically. So I'm gonna say if this ratio here, right, is more than 50%, then that doesn't have to be filled. Okay, cool. Awesome. We have something to backtest.
And the body to the previous wick.
Body to the previous wick. Cool. Awesome. Cool. Let's backtest it. So higher time frame wick is a lower time frame FVG or V-shaped recovery, right? Oftentimes it's both an FVG and a V-shaped recovery, right? V-shaped, FVG, higher. So that's why we don't need to trade back in to this fair value gap. Let's do another example of this because I think this one has been the most complicated for both me to probably teach and for you to understand, probably because I haven't taught it fantastic thus far. So let's find another example. Here is another good one. And this is an example. Right here. So what can we say that a potential draw on liquidity was? First of all, let's see if this validates with a key level divergence. Yeah, okay, we get it right here. There it is. Perfect. So this is going to be considered our lower time. You guys see how we have a key level divergence, which is this swing low? Looks like an hourly chart, and you'll see what I mean by the key level divergence. Go down. Okay. You see how we have this SMT divergence right here?
Yeah.
Okay. So on the sell side of the curve, I'm asking a question. Is this gap a breakaway gap on the sell side of the curve? All the way down into this premium area of the chart right in here. Is this a breakaway gap?
Looks like it.
Yep. So now you know, again, saying all fair value gaps get retraded is a useless statement to me because we want to know if the next day we can expect lower or higher prices. And seeing this, does this third candle meet the condition for a deep retracement? Look at where the candle opens. Look at how far it goes. Look how far it comes back. Does that give us an indication of the next candle going lower or higher? What would you say?
Lower.
Yeah.
Lower.
Now, I don't care that this candle gets retraded to eventually because it gets retraded to on what side of the curve, guys? The buy or sell side?
Buy.
And why is it the buy side of a curve?
SMT.
And?
Drawn
What about you?
Yeah. So this is not... So when people ask you, and they will, is this a retracement or a reversal? They will. People will ask you, is this a retracement or a reversal? And when I say people, I mean me.
My girlfriend?
Is this a retracement or a reversal, Todd?
I'm sorry, man. I'm over here laughing. It's Friday night. What is what?
Is this a retracement or a reversal? There's only one answer. That's right.
It's a reversal.
And then I can guarantee you, I have not seen ES. I have no idea what ES does. I've only looked at NASDAQ. There is an SMT here. I can guarantee with ES or YM. I'm going to pull up both. I haven't seen either. On this high, there's an SMT. Who wants to put $5 on it? $5? Boss?
$5.
It's an
I like go
SMT.
against you, man.
Okay. SM, $5.
There's-
There's an SMT formed at this high, okay? On YM or ES. That's good. Okay. Reveal in 3, 2, 1. Boom. You owe me $5, buddy. Now, how do I know that there's an SMT formed? And this wasn't subjective. In my mind, I was willing to put $5. It was a wager I was willing to take for one reason. Because I'm using the breakaway gap theory to now show how we use this in market maker models. This is something Arjo will not teach you. So let's spend some time here really dissecting what we're seeing here. This is not just a breakaway gap. This is full market maker model, ERL to IRL reversal, using this confluence to frame that reversal. What do I mean by that? This fourth candle, Todd, should we go lower or higher based on what are we framing this as? What kind of third candle is this?
Rebalance, redelivered.
So this is is this a deep retracement, a displacement, or a consolidation?
With the third candle.
Yep, this third candle in here. Is this the deep retracement type, the consolidation type, or the displacing the low of the second candle type?
I feel like this one's a little bit of a harder read because that's a big fair value gap.
But if you had to choose one, you have to choose one. Which one is it?
I think it's a.
Rebalance.
Yeah, it's a deep retracement, right?
Rebalance. Yeah.
Yusuf,
deep
is this?
retracement.
Remember what we said we were going to compare? We were going to compare how deep this came in relation to the open as opposed to the entire gap, right?
Oh, okay, good.
So
Yeah,
this
yeah.
is the entire gap, and this is the open. We've retraced more than 50%. Yes or no? Let's use originals thesis.
We did not.
Okay, it's very close though, right?
That's why it retraced back up.
But did it retrace or reverse? What do we say? And how do we know it's a reversal?
SMT.
And a higher time frame array, this daily fair value gap, right? And how do we know there's an SMT here? Because the state of delivery of this candle is not to retrace this gap. What is the state of delivery designed to do?
SMT again.
Run out the high. Do you guys understand that
Yeah.
difference? I want to stress it. This is not a retracement of this fair value gap. It's not. We are not retracing this fair value gap, guys. This is a breakaway gap. Do you not believe me? This gap here is a breakaway gap, and I can prove it because we have an SMT here. Meaning, ES didn't just retrace the gap. That wasn't the purpose. Look at what ES did, guys. ES ran out the high. That's IRL to what?
IRL to ERL.
ERL.
That's a complete market maker model. We'll spend as long as we need to on this example because this is critical. This is not a retracement. This is not a fair value gap retracement, guys. This is an internal to external market maker buy model. I promise. And you can frame that by knowing the SMT exists here in hindsight, but I didn't know that. I just used the idea of this deep retracement and then this SMT. So on the buy side of the curve, it will be retargeted, right? We said that. But on the sell side of the curve, what is this?
Breakaway gap.
Thank you. Let's take a picture of this and everyone put it into their journal now. This is
cool.
it's critical. Like, this is the stuff that you won't get taught in these videos, which I spent time in the last couple of weeks back testing. So go in, not breakaway gap. Where is that? Go in and back test this. Don't take my word. And I want you to write down in your journal, this gap, even though we retrace it here, is not being retraced. It is being reversed against, and this is forming a SMT divergence, meaning we are moving from internal range, SMT, right, higher time frame PD array, to external range, SMT, higher time frame PD array. This gap, in my mind, is not considered on this side of the curve. So when we hold this gap, there's ICT traders who say, look, right, we continued, we held this gap, we were expected to trade up into it. No, we only trade back into it once we reverse on the intermediate time frame, i.e., we have an hourly market maker buy model that forms the SMT. So now once we form that SMT here, that's not external to internal, that's external to external, and now we can target this low. And we can see where price goes.
Well, wouldn't it be internal to external?
Well, in this case, but ES runs out the high, right?
So we're not actually counting that as internal because that's not what the function of that gap is.
The function of the gap is.
No, I'm talking about the other way around. I mean, I guess I'm talking about like I'm treating it like we took external liquidity on NQ.
Yeah,
so.
exactly. Yeah, we took external on the daily, right? And there's no.
So the SMR there is internal to external.
Here we took out external, right? Assuming we took it out on NASDAQ because of the SMT. But there's no internal ranges to retrace. So what's our immediate draw on liquidity? This external range low. External to external, right?
Oh, yeah. I'm sorry. I was just talking about the previous move from the BISI, the higher BISI down there. That move is...
Yeah, this is internal to external. Yep. Fantastic. Right. Internal to external, external back to external. Because now we have created a range, right? And this is a low. Again, it might seem like semantics. Like you might just say, okay, if he's like, it doesn't matter, this fair value gap holds regardless. But I want you to understand that in the way I see price, seriously, for me, there's a big difference. There's a large difference between seeing this as a reversal versus a retracement. In my mind, this is not a retracement. I am not looking for this gap to offer support. I am expecting a high to be ran, which is why I was willing to bet SM that $5 that we would run out a high, because the program or the state of delivery is this high in my mind. And this time I was right. Maybe I'll be wrong next time. What's up?
The only argument that I would just bring up would be that ES did not make an actual gap. It just immediately rebalanced it.
That part is interesting.
What about this volume imbalance?
So in this case, wouldn't NQ be the one that first reversed, and then ES was the one that broke the external and then reversed afterwards?
So you're saying that NQ reversed first down here, right?
Well, no, by that big displacement candle on the second candle.
This one?
No. The second candle, the one with the gap.
Oh, this one.
Yes.
I see. Yeah. What did ES actually did in a full immediate rebalance, right?
Mm.
So we can see that the concept of entirely rebalancing the range has been applied to ES here, correct?
Correct.
So this would be a daily bit. This would be a daily SIBI in here, but because we have an immediate rebalance wick, this is an immediate rebalance candle, but this is even more bearish of a signature, right, on ES?
Exactly.
So then the next day when we formed the SMT, right, we expected lower prices and we got it, right? At the low, did we liquidate the draw technically on ES when we formed the SMT? Is this low taken?
Yes.
Yes. We treat SMT as a liquidity sweep on both, correct?
Yeah.
Oh, okay.
Right? You've heard me say that. Whenever we see an SMT, we take our partials off, right? Because what do we treat an SMT as? As both indices taking this low, right? So does this immediate rebalance deliver the low? Given our logic,
Yes.
right? Because we get an SMT. Now, is this gap being retraced or are we reversing to this high? Is the question. We're
Reversing to the high.
and we get it. You can see we get it, right? And that's why we have this bullish candle that comes all the way up, right? On ES, takes out the high, and is contained in this fair value gap here because it doesn't need now to reach up into that high. But the state of delivery for me is bullish until what happens? The SMT. Does that make sense?
That makes sense. Okay.
I'm not sure. Okay, here's what it means in real time. I'm not shorting the gap, guys, until I see the SMT. I'm waiting specifically for the SMT at the daily high. So let's look at the lower time frames. I am not
For when the
shorting
highs
this
get
gap
broken.
ever. See how we trade into it here?
Mm-hmm.
I'm not shorting it. That's powerful information because you might take a winning trade on this day but get absolutely railed trying to go continuation the next day on Wednesday, right?
Mm-hmm.
I'm not shorting it here until this forms. At this point, this now becomes an order paired high. So now I'm saying a candle body closure through that high is the invalidation. Whoa. And we'll never get that. We might wick it, but we'll never get a candle body closure. Look at that. You see? That's algorithmic because this area is the order paired high. Do you see how we just wick it? We never close through it. And what do I use as my invalidation, guys, of my trades usually?
Closure.
Closure. Do you see why I use closure? Because this could easily be the 5-minute chart as well, right? And then you're sitting through 5-minute chop, and then eventually do you get the move you want? Down to what? What's the draw? Remember we said it's this low. What are we creating in here? Remember, this is all in context of MMXM now. We're not even looking at the breakaway gap anymore. We're just using that to frame. You see this market maker model, the sell model with these equal lows? So if this was your 5-minute chart, for example, or you're trading the hourly model and you take entries on the hourly, where would you take your entry? Well, once you see the SMT and you get this big down close candle, you want to short, right, the low risk entry.
So you were essentially looking at both markets as if they were one market.
Always. Always.
Okay.
And that's why you'll always see me have this chart up, no matter what. Remember today, that's why we were bullish biased, right? Remember in the stream this morning, we talked about how we don't want to be shorting if we don't reject this area on YM with a wick. Because what is YM taking this low equal to us in our mind?
NQ taking a low.
And
Right.
cool. Yeah, exactly. And look what happened today with price, right? Came right into our area of interest. OTE. Retracement back into a premium. Because we're looking at intermarket analysis always because this is viable to go long because of the SMT. We're viable and able to go long here because this is order paired the low. So now when we look at this chart here, right? Where would our entry be if we wanted to short? The minute we see this smart money technique up here, we get a low risk entry in this fair value gap. Do you see the power of using this this concept? Where are you going to stop yourself out? A closure above this high. Where are you going to target? Oh my goodness, I have to go short. You're going to target, you're drawing liquidity. Do you see how you don't care that this fair value gap in here gets closed through? Do you see how it doesn't matter to you? That's still your low risk entry? That is still your low risk entry. That would be where I would short if I was trading the daily model because I saw the SMT and then what do we get after the SMT, Yusuf?
You just said you had a.
What do we get after this SMT that makes me shorten here and be willing to hold through this fair
Speed.
value gap closing?
Speed.
Yeah, and market structure shift, right? So the protected high is what?
On ES.
And this high on NASDAQ, right? Both of these?
Mhm.
So now when I see this liquidity sweep, I'm not stopping myself out of my position. So I get asked all the time, when do you trail your stop? If I was trading the hourly model, I would have entered, right in here, in this fair value gap, probably right at the CE. Or maybe right at this order block right there. I would have been risking a closure through this high. So this is variable. This stop loss can look something like this. Closure through that high is my invalidation because that is the order paired high. I don't care if my fair value gap has been closed through because my narrative is that that is manipulation. This is a fake break of structure higher above this high here. And this is the order paired high. As you notice, we'll never close a body through it. We might come into it multiple times. 1 time, 2 times, 3 times. We'll keep creating these failure swings to the upside. And then eventually we'll break down. So if I'm a swing trader, this is how I actually view my position. I'd make a 2R trade right here. There you go.
I think it's kind of a different topic for another lecture maybe, but I think it's interesting and kind of noteworthy that ES didn't then challenge that high. You know, like NQ was the one that didn't take those other highs and was lower on the SMT, then got its high tested and order paired a lot. But ES, which took the high, really clearly didn't even come close to like waking it over.
Which pair do you usually see me trade actually on the lower time frame? I said it this morning too. Someone asked this question. Which pair would I prefer to trade? The pair that makes a lower low on the intermediate time frame, or the pair that makes the higher low? Even if I'm bearish, what would I rather trade?
The one that makes the lower high.
The pair that makes the higher high. Do you know why?
Okay.
What's happening above this high that we always talk about with market maker models? What rests above here?
It becomes HRLR.
HRLR, yeah, nice. Buy stops, HRLR. This is order pairing, no? Does NASDAQ order pair this high?
Right. That's what I'm saying. Yeah, exactly.
Yeah. I would rather short the index that trades higher. Because for me, it has counterparty liquidity. Remember we were talking about hedge plus and hedge minus? This move
already
higher.
order paired.
Yes. This is an order paired high. That's why my condition, guys, is a closure through this high. Because if we close through it, that SMT has been invalidated. Some people use a closure of this high. You've probably seen that before too. But for me, if I'm trading that high is too high for me to cover. I'm going to use the SMT high and say price doesn't need to close above this high. It can retest this high, retest this area, but it doesn't need to close above it because that is the order paired high on ES, right? So while ES is jawboning in this what? Premium array. Do you guys see this fair value gap? It never closes to even remotely close to. While ES is jawboning in here, NASDAQ is retesting this high, right?
Because, well, more specifically, NASDAQ is order pairing up there because an ES order paired.
Yep. NASDAQ gets a liquidity sweep right here. Whoops. There's a liquidity sweep right there.
So basic, interesting.
Which forms what? Another SMT.
Yeah.
And have you guys heard me talk about sequential SMTs or SMTs within SMTs? Look at the higher time frame SMT. What is it? This weekly SMT, correct? Wednesday. Now, what's the lower time frame SMT? This daily SMT. Do you see how we have an SMT within an SMT? Well, look what happened this morning. What do we have this morning? Yesterday, what did we do with the Dow? Right down here at the 20-day low. Last thing, guys, then we can move on. And we can finish up. What did we do yesterday at the 20-day low?
Daily SMT.
With YM.
Wait, Talon, I'm asking again. What time frame SMT is at the 20-day low? I just said it. 20-day low.
Monthly?
Monthly. What is the intermediate time frame to the monthly? This is getting into something called sequential SMT. What is the intermediate time frame to the monthly?
Daily.
We wanted to see a daily SMT before we longed. We have a monthly higher time frame divergence. Now, what did we get? Look at this low on NASDAQ. What time frame is that SMT? Make this line really big, guys. What time frame is this SMT? Look at ES. It's right here. What time frame is this SMT, guys?
When you're on the 15-minute.
So 4 hours?
No, I'm just. What day is this? What low? What day does this low correspond to?
Previous day as well.
Previous day low. This is a new day. So what time frame SMT is this? I can go again to my higher time frame chart and show you. The time frame that this is on does not matter. What time frame is this SMT?
Technically the daily.
Yes. It's hard to see on this 1 day chart, so let me go to the 4 hour and you'll see it clearly. What time frame is this SMT? Do you see? NASDAQ makes a lower low. ES makes a higher low. That's a daily SMT. So what do we have now? We have a, what's the higher time frame SMT? Someone say it again. What do we say? IP to 20 day is the what time frame?
Daily.
Monthly. Right? This is previous month, right? March 5th. Do you see that? Come on, you guys got this. This is March 5th, right? Do you guys see my chart?
Yeah.
So what
Yeah.
time frame divergence is this?
Monthly.
Monthly.
SMT.
What is the intermediate time frame to the monthly?
Daily.
Do we get a higher or a lower time frame SMT in the higher time frame SMT? Yes or no?
Yeah.
This is called
Yeah.
sequential SMT. This is something taught by Day in his private mentorship. It's looking at quarterly theory or time-based SMTs. Again, time before price. When you have a higher time frame cycle SMT, then you look for a lower time frame SMT in the lower time frame cycle, and you want to see both, and you turtle soup that low. Not today's lesson, but still very cool. Do you see how we do that, though? Do you see how we do form that divergence here with ES? This previous day low? It's not a random occurrence. Anyways, that got like super off track based on what we were talking about. But that's, do you see the same thing happen here? Let's just, for the purpose of learning, let's just do it again one more time. So here we have our SMT form. Okay. So what time frame SMT is this, guys? This is
Weekly.
Wednesday. This is Thursday.
It's monthly.
No, this is the hourly
Weekly
chart.
SMT.
Weekly. Okay? Or even this, yeah, this could be considered a weekly SMT. What is the lower time frame to the weekly? One step lower?
4 hours. 1 hour.
What time frame SMT is this?
Daily SMT.
This is 4 hour SMT, right? Or daily SMT. It's okay. You can use the weekly and daily. Do you see how this is a lower time frame cycle SMT? Here's the higher time frame SMT. Here's the lower SMT. And then we get the actual true distribution.
Can we get another SMT again at the highs before we go down?
Hey, we have one more right here.
4
Yeah.
hours.
Is this talking about this one right here?
Yeah.
Yep. But this is the one that you would turtle soup. So this is the high that you would turtle soup because that high should be protected. Higher time frame cycle, lower time frame cycle. Let's see if we can get the same. Okay, the lesson's over. I'm going to stop recording. Let's see if we can